Hey, welcome back to Finoodle, where finance gets simple. If you've ever looked at the stock market and thought, I have absolutely no idea what any of this means, you're not alone. Most people hear stock market and picture a bunch of guys in suits screaming on a trading floor or some genius staring at 6 monitors at once. But here's the truth. The basic idea behind the stock market is something a 10-year-old could understand. So today, I'm going to explain, from absolute zero, how the stock market actually works, why it exists, and how ordinary people use it to build wealth. Let's say Lisa starts a lemonade stand. Business is great. She's selling 50 cups a day. People love it. Now Lisa has a big dream. She wants to open 10 locations across the city. But that takes money, a lot of money, way more than she has. $100,000. She has 3 options. Option A, save up for years. Option B, borrow from a bank. Option C, sell tiny pieces of ownership in her company to other people. This is what a stock is. This is option C. And this is basically what a stock is. A stock is simply a tiny piece of ownership in a real business. Lisa divides her company into 1,000 equal pieces. Each piece is called a share. She keeps 600 shares for herself and sells 400 to the public at $100 each. She just raised $40,000 without borrowing a penny. Those 400 people are now part owners of Lisa's Lemonade. They are shareholders. If the company does well, their shares become more valuable. If it tanks, their shares lose value. Once those 400 people buy Lisa's shares, what if one of them needs their money back? They need a place to sell their shares to someone else. That place is the stock market, a marketplace where you buy and sell tiny pieces of companies. The 2 biggest stock markets in the US are the New York Stock Exchange, the NYSE, and the NASDAQ. But almost every country has its own stock exchange. Almost every country has its own stock exchange. London, Tokyo, Shanghai, Mumbai, Frankfurt, they're all connected in the global financial system. Here's the key thing. The stock market doesn't set prices. People set prices. If a lot of people want to buy, the price goes up. If a lot want to sell, the price goes down. It's supply and demand, the same force that decides the price of everything from coffee to concert tickets. So you bought a stock. How do you actually make money from it? There are 2 main ways. Way number 1, capital gains. You buy a stock at one price and sell it later at a higher price. The difference is your profit. You bought at 50, sold at 80. You made $30 per share. But if the stock drops and you sell at 30, you lost $20. That's a capital loss. This is why investing always carries risk. Way number 2, dividends. Some companies share a portion of their profits directly with shareholders. If you own 100 shares and Lisa pays $2 per share, that's $200. Just for holding the stock. You didn't sell anything. The money just showed up. Not every company pays dividends. Younger, fast-growing companies usually reinvest all their profits back into the business. Older, established companies like Coca-Cola tend to pay dividends consistently. Both approaches can build wealth. It depends on your strategy. If you've ever watched a stock price, you know it moves constantly, sometimes every second. Why? There are 4 main forces: company performance, the economy, interest rates, and human emotion. Strong sales and profits push prices up. Losses and scandals push them down. A strong economy lifts stocks. Recessions sink them. When central banks raise interest rates, borrowing becomes expensive and stocks often drop. But the biggest force? Human emotion. Fear and greed drive the market more than most people admit. When people panic, they sell, even when nothing is fundamentally wrong. When people get greedy, they buy at ridiculously inflated prices. Warren Buffett said it best: be fearful when others are greedy, and greedy when others are fearful. There are thousands of stocks. How do we know if the market overall is doing well? That's where indices come in. The S&P 500 tracks the 500 largest U.S. companies. The Dow Jones tracks just 30. The NASDAQ composite is heavily weighted toward tech. When people say the market was up today, they usually mean the S&P 500. Here's the important takeaway. If you zoom out over 10, 20, 30 years, the overall direction is up. There are crashes along the way. But historically, the market has always recovered. This is why long-term investing works. You don't need to walk into the New York Stock Exchange. You don't need a suit or $1 million. Today, anyone with a smartphone can start investing in minutes through an online brokerage. Platforms like Fidelity, Schwab, or Vanguard let you buy stocks with as little as $1. But here's my honest advice. Don't start by picking individual stocks. Even professional fund managers fail to beat the market most of the time. Instead, consider an index fund, a basket holding all the stocks in a particular index. Instant diversification, low fees, 7 to 10% average annual returns. You just invest consistently and let time do the work. Remember compound interest from episode 1? This is where it comes to life. Your money earns money on money, and the snowball just keeps growing. Before we wrap up, 5 golden rules of stock market investing. Rule 1. Invest money you won't need for at least 5 years. Rule 2. Don't try to time the market. Rule 3. Diversify. Rule 4. Don't panic sell. Rule 5. Keep learning. The stock market is volatile short-term. Keep money in for 5+ years. Nobody can predict the market. Don't wait for the perfect moment. Never put all your money in one stock. Spread it across companies and countries. Markets crash, but every time in history, they've come back stronger. Keep learning, bonds, ETFs, real estate, tax strategies. That's what this channel is for. So let's zoom out. The stock market is just a place where people buy and sell tiny pieces of real businesses. Prices move based on company performance, the economy, interest rates, and human emotions. The simplest way for most people to invest is through low-cost index funds held over the long term. It's not about getting rich overnight. It's about getting a little bit richer every year and letting time and compounding do the heavy lifting. If this made money make a little more sense, smash that like button. Subscribe if you haven't already, and share this with someone who needs to hear it. It helps more than you think. I'll see you in the next one.